Welcome back to MacroNav, the explainer series designed to help you understand how macro drives markets like a pro, even if you're not one. This episode is a companion to our weekly market update podcast, where two generative AIs trained by a senior portfolio manager dive deeper into what's really driving global markets. Here, we focus on making sense of the key moves, the hidden signals, and the risks you absolutely need to keep on your radar. And let me tell you, this past week was one of those moments where everything shifted almost overnight. If you're not paying attention, you could miss the big picture that's unfolding right now. So stick with us until the end, because what we unpack today could change the way you think about where markets are heading next. Before we start, don't forget to like this video, subscribe to the channel, and hit the bell icon so you never miss these weekly explainers.
All right, let's get right into it. So, picture this. For 4 straight days, the markets were just down. It was looking like a total losing week, plain and simple. And then Friday hits, and boom, everything flips. The Dow Jones rockets to a new record high. So you have to ask, what on earth happened? What was the one thing that turned this entire week around? Well, it all came down to these 4 little words from the Federal Reserve Chair Jerome Powell. Speaking at that big annual conference in Jackson Hole, he basically admitted there are risks to the economy and hinted that the Fed's tough guy stance on interest rates, well, it might be ending. And that was the exact signal the market had been holding its breath for. Now, what Powell did is what the pros call a dovish pivot. It's actually a pretty simple idea. Think of it this way. A hawk is aggressive, right? It's fighting inflation by jacking up interest rates. But a dove is much gentler. It's more focused on helping the economy grow, usually by cutting rates. So Powell's comment signaled this huge potential shift from hawk to dove. And for investors, that is a massive, massive deal. So how did this massive news actually play out in the U.S. markets? Well, it wasn't some simple story where everything just went straight up. It was more like a tale of 2 completely different markets reacting in completely different ways. Just look at these numbers. They tell a really fascinating story. You've got the Dow Jones hitting a record high, up 1.5%, and then look at the Russell 2000, that's the small cap index. It surged an incredible 3.3%. But then you look at the tech-heavy NASDAQ, and it actually finished the week down. So what gives? What we saw was this huge rotation of money out of what we call growth stocks and into value stocks. You see, when the market starts sniffing out lower interest rates, sectors like financials, energy, and basic materials, the real backbone of the Dow, they tend to do really well. Big tech, which has been the star of the show for so long, suddenly took a back seat for the 2nd week in a row. And just how certain is the market that a rate cut is coming? Well, this certain. According to what are called Fed Watch futures, traders are now pricing in an 83.1% chance that the Fed will cut rates at its very next meeting in September. I mean, that is just an incredibly high level of confidence. But, the Fed isn't making this decision in a bubble. The actual economic data coming in is, well, it's pretty complicated. On one hand, you have business activity hitting its highest level this year, and the housing market is picking up. That's great. But on the other hand, more people are filing for unemployment, and businesses are complaining that tariffs are driving up their costs. It's a really mixed bag out there. Okay, so let's zoom out for a second and look at the global picture, because this is really interesting. While the U.S. is going all in on betting on rate cuts, the rest of the world seems to be on a very different path. Central banks are really starting to go their separate ways. Let's hop over to Europe. We're seeing some good signs, some green shoots. Business activity is growing for the 3rd month in a row, which is fantastic news. But here's the catch. The average person on the street isn't feeling it yet. Consumer confidence actually went down. So there's a real disconnect between businesses and households. Now, meanwhile, you go across the channel to the UK, and they've got the total opposite problem of the US. Inflation is really heating up, hitting 3.8% in July. Their target is 2%. So it's nearly double the target. This puts huge pressure on the Bank of England to keep rates high, definitely not to cut them. And it's a really similar story in Japan, of all places. For literally decades, they couldn't get any inflation. Now it's stuck at 3.1%, way above their 2% target. And because of that, the market is now betting that the Bank of Japan is actually going to have to raise interest rates soon. Talk about a reversal. And then you've got China. Oh boy, the mainland markets there have been on an absolute tear, hitting a 10-year high. But the really critical detail here is who is driving this surge. It's not the big institutional players. It's being fueled by a massive wave of everyday individual retail investors. And that brings us to this flashing red warning sign. Margin financing, that's just a fancy term for money people borrow to buy stocks. It has soared to levels we haven't seen since the big market crash back in 2015. This means this incredible rally is being built on a mountain of debt, which, as you can imagine, adds a huge amount of risk if things suddenly turn south. So you've got the US market soaring on these rate cut hopes, but the global picture looks messy to say the least. So what could actually knock this whole rally off course? Let's break down the biggest risks that are really on the horizon right now. All right, let's walk through these. Number one, right here at home, if US inflation suddenly spikes, that could kill these rate cut hopes literally overnight. Two, even if inflation behaves, a weakening labor market could bring back recession fears in a big way. Three, those rising costs from tariffs could really start to bite into company profits. And then looking abroad, that debt-fueled party in China could come to a crashing halt. And finally, all these central banks going in different directions could create some major chaos in the currency markets. There are a lot of moving pieces. So, after all that, where does this leave us? Let's nail down the final takeaway and focus on exactly what you need to be watching in the week ahead. The week is going to be packed. We've got important data on housing, manufacturing, but honestly, all eyes are going to be on Friday. That's the day we get the PCE price index. And look, this isn't just any old inflation number. This is the Federal Reserve's preferred, most watched inflation report. This is the big one that could either confirm what the market hopes or completely shatter it. And that really brings us to the final multi-trillion-dollar question. Jerome Powell has set the stage. The market has placed its bets, an 83% certainty of a rate cut. The rally is on. But at the end of the day, it all comes down to the data. So, will this week's big inflation report play along, or is this entire market in for a rude awakening? We're all going to find out on Friday.
If this helps you stay ahead in markets, hit that like button so more people see it.